A subscriber to this channel recently made a really valid comment which reads, "Hi, you seem to favour Vanguard funds where there are now some cheaper or similar options from other providers. Why is that?" My investment journey started on the Vanguard platform, and the majority of my portfolio still consists of Vanguard funds, which is why my videos often include their investments. But this comment got me thinking, and is actually the inspiration for this video, where I thought I would compare 4 of the most popular Vanguard ETFs with some ETFs from other providers to see if there are better funds elsewhere to consider switching to. To make comparisons, I'll be looking at some of the usual stuff such as fees, currency class, risk, portfolio data and past performance. With past performance, any figures I provide are for guide purposes only and should not be taken to be an indicator of what will happen in the future. Where possible, I will calculate how much you would have earned if you'd invested £10,000 as a lump sum 5 years ago. And for consistency, I will try and pull as many figures as I can from the Morningstar website using their ETF screener, and I'll leave a link to this website down below. To make comparisons as like-to-like as possible, I'm going to concentrate on ETFs only and exclude any of Vanguard's mutual funds. And most of the funds I've featured today are available in your own currency if, for instance, you live in the US, so they should be of use to you as well. Who knows, I might be totally overhauling my Vanguard portfolio by the end of this video, so let's see. The first ETF I'll be comparing from Vanguard is the Vanguard FTSE All World UCITS ETF. The ticker for the accumulation version of this fund is VWRP, and there is also a distribution version with the ticker of VWRL. You will get paid dividends no matter what version of the fund you choose, but with the accumulation version, those dividends get reinvested automatically. With the distribution version, the dividends get paid to you and it's your choice what to do with them. And some investors might use the distribution version to use the dividends as income, for instance. But if just trying to invest for the long term and to build wealth, the accumulation version would seem to be the most efficient and low maintenance. This version of the ETF is sterling denominated and traded on the London Stock Exchange, and the fund size is on the screen. The ongoing charge figure for this fund is 0.22%, meaning that for every £10,000 worth of fund that you own, you pay £22 per year. The OCF, or ongoing charge figure, is the fee that the fund manager charges for its administration. And that OCF, along with the custody or platform fees, are the 2 investment costs that you're more likely to encounter. And you should try and keep these as low as possible. As all the funds in this video today are ETFs, then they are all available on the Trading 212 investment platform. So if you stay in your home currency and away from foreign exchange transactions, there will be no custody or platform fees for you holding your ETFs with them, and you will only pay that OCF charge. Being passive, all the ETFs in this video just try and track an index and mirror its returns. I could try to better the market return of an index by choosing an active fund, but this would cost me more with higher OCFs, and there's no guarantee that these higher prices would provide me with better results. In fact, history tells us that those more expensive active fund managers fail to outperform those cheaper passive ETFs in the overwhelming majority of instances. And talking about indexes tracked, on this occasion, this ETF tracks the FTSE All World Index. This is a global index of mid and large size companies, also referred to as mid and large cap, and includes countries from emerging market regions such as China and India. This ETF has 3,681 holdings at the time of making this video. An ETF portfolio data does change from time to time, so it might have changed by the time I publish this video, but it will be similar. The USA is by far the country with the biggest proportion of this ETF, taking up 62.85% of it, and you will see this as a recurring theme throughout this video. Emerging markets take up roughly about 8 to 8.5% of this fund, with the technology sector accounting for 26.67% of it. The top 10 companies take up 22% of the fund, with all but one being from the USA, and that one is Taiwan Semiconductor at number 10. The risk factor for this fund is 6, and that is the same with all the funds that we feature today. Price volatility, which is closely associated with risk, is measured by standard deviation. Generally, the bigger that standard deviation number, the higher the price volatility and the riskier the asset. And the 3-year standard deviation figure for this ETF is 16.60%. Another metric worth measuring is the Sharpe Ratio, which evaluates the return of the fund in relation to its risk. With the higher the figure, the better. And in this case, the 3-year Sharpe Ratio figure is 0.23. The 5-year annualised return for this ETF is 9.62%. This does not mean that it has returned 9.62% every year. Some years it would have been lower, others it would have been higher, and this figure is just an average figure over 5 years. So with this one, if you'd invested £10,000 as a lump sum 5 years ago with no further investments since, it would have returned you £15,828.24. but remember you also have to deduct the OCF from that. As we move through the video, you will see the comparison options are not always as plentiful as they were seen if trying to compare apples with apples. So when looking for a comparable ETF that tracks the FTSE All World Index, is sterling denominated and traded on the London Stock Exchange, there's only one option, and that is the Invesco FTSE All World ETF. FWRG is the ticker for the accumulation version, and the distribution version is FTWG. The fund size is still reasonably big, but a lot smaller than the Vanguard version of this ETF. But this is a newer fund, roughly a year old, so this is to be expected. What appeals to me here is that ongoing charge figure, which is a much lower 0.15%, which equates to £15 for every £10,000 worth of the fund that you own. The difference between 0.22% and 0.15% might not seem a lot, but if investing over a longer period of time, that difference in cost could really impact on compounding and your longer term returns. This ETF is smaller with 2,645 holdings, with the US taking up a slightly larger 62.98% of the ETF. With this one, emerging markets takes up a slightly lower 7.5 to 8% of the fund, and the technology sector accounts for a lower 25.13% of it. The top 10 companies also take up a slightly smaller 21% of the fund, and again all are from the USA apart from Taiwan Semiconductor, which is at this time number 7. This fund is just about 1 year old, so we can't provide you with standard deviation figures as yet, nor with Sharpe Ratio figures, but its 1 year performance is 17.44%, and year to date is 12.14%. Although this is too short a time scale to measure anything, those figures are slightly better than measuring the same time periods with the Vanguard fund. So in summary, this fund is just too new to provide accurate comparisons with that FTSE All World ETF. It is definitely worth keeping an eye on, as if future performance is similar, then that OCF of 0.15% might make this an irresistible choice. For the next ETF comparisons, let's switch to the developed world and look at the Vanguard FTSE Developed World UCITS ETF. VHVG is the ticker symbol for the accumulation version. The distribution version is VEVE. This version of the ETF is again sterling denominated and traded on the London Stock Exchange, and the fund size is $5,933 million. I'm mentioning this figure as the more established an ETF is, the larger you would expect that figure to be. And if you compare this with the Invesco ETF we've just covered, you can see the difference. It could be argued that the larger that fund size is, the less likely it is to fail. But I'm not for 1 minute saying that Invesco fund is problematic, by the way. So the ongoing charge figure for this fund is 0.12%, meaning that it will cost you £12 for every £10,000 of fund that you earn per year. And this ETF tracks the FTSE Developed World Index. This ETF is again global, focusing on the developed markets, meaning that it excludes countries such as China and India. This ETF has 2,092 holdings. This is a smaller figure than those all-world funds, which is to be expected, being that it excludes those emerging market companies. However, make no mistake, this fund is still diverse. Diversity is not putting all your eggs in one basket or betting on a specific number in a roulette game. It is a fantastic free risk management tool that helps reduce volatility in your portfolio. If one company, region, country or sector doesn't do well, then the idea is that others will take up the slack and help to smooth out market returns. Obviously this works both ways, so it could slow down growth in your portfolio also. It's therefore about finding an appropriate risk to match up with your tolerance and what you're trying to achieve in your long term with your objectives. The USA is the biggest country in this ETF, accounting for 69.9% of it, with the technology sector accounting for 26.9% of the fund. The top 10 companies take up 24% of the ETF, with all being from the US. Though all the ETFs featured in this video so far are diverse, they are all heavily concentrated on a particular country, a particular sector, and a particular top 10 companies. The 3-year standard deviation figure for this one is 17.19%, and in this case the Sharpe Ratio figure is 0.29. Using the longer established VEVE distribution version of this fund to provide past performance figures, the 5-year annualised return for this fund is 10.95%. And it will seem that emerging markets has been a drag on the performance of those global funds, as we now have better figures where they're excluded. If you'd invested £10,000 in this fund 5 years ago as a lump sum with no further investment since, this ETF would have returned you £16,812.66. But again, remember to deduct those OCF charges. And in trying to find a comparison for this developed world ETF with another provider, again, choice is limited with there being no established ETF that tracks the same index. Therefore, I've had to change index for this one, and I've turned to the MSCI World Index. This is also a developed world index with similar structure and performance to the developed world FTSE index. An ETF I've found to compare with it is the SPDR MSCI World UCITS ETF. The ticker symbol for the accumulation version of this fund is SWLD with no distribution version available. Again, this version is sterling denominated and traded on the London Stock Exchange, and you can see the fund size on the screen. The OCF for this one is the same as the Vanguard fund at 0.12%. Like the FTSE Developed World Index, the MSCI World Index is an index of developed countries of large and mid-sized companies. That excludes emerging market countries such as India and China. This ETF has 1,413 holdings. The US accounts for a larger 69.3% of it. The technology sector accounts for the same, 26.9% of the fund, with the top 10 companies, all from the US, accounting for a larger 25% of it. The 3-year standard deviation for this one is almost identical at 17.18%, and the 3-year Sharpe Ratio is slightly higher at 0.32. The 5-year annualised return for this fund is also higher at 11.16%. So if you'd invested £10,000 5 years ago with no further investment since, this ETF would have returned you £16,972.33. That's a massive £159.71 more than the last fund. Everything in these two funds is very similar, with there being a slightly better return from the SPDR fund for a little less volatility and risk. I invest in the Vanguard FTSE Developed World ETF, and none of the data here really makes me want to switch. But maybe, if you were thinking of adding a Developed World ETF to your portfolio, then the SPDR one might be worth considering before you make your choice. The ETFs featured so far have had a strong US flavour, so the next one we're going to look at is actually 100% US, and that is the Vanguard S&P 500 UCITS ETF. The distribution version of this fund is VUAG, with the accumulation version being VEVE. Again, it's sterling denominated and traded on the London Stock Exchange, with the fund size being on the screen. The OCF for this fund is very low at 0.07%. This means that it will just cost you £7 a year for every £10,000 worth of fund that you own. The technology sector accounts for 33.36% of the fund, with the top 10 companies taking up 36% of it. Most of these top 10 are from the tech sector, which has been the consistent main global driver. The 3-year standard deviation figure for this one is 17.83%, slightly higher than those global funds. This is understandable, being that it is concentrated on one country and less diverse. The Sharpe Ratio is also higher at 0.42, and the 5-year annualised return is not to be sniffed at either at 13.57%. So if you'd invested £10,000 in this fund 5 years ago with no further investment since, then this fund would have returned you £18,893.74. There are many other ETFs that track the S&P 500. I've opted for a sterling denominated version to try and keep comparisons as like for like as possible. And this is the Ishares CORE S&P 500 ETF, which has a ticker symbol of CSP1. There is also a sterling hedged version of this ETF with a ticker of GSPX. The ongoing charge figure for this one is the same as the last at 0.07%, with the technology sector accounting for a slightly smaller 32.12% of the fund, and the top 10 companies account for a smaller 34% of it. The 3-year standard deviation for this one is almost identical, 17.84%, and the Sharpe Ratio is also 0.42. The 5-year annualised return for this one is an almost identical 13.56%, thus providing similar returns if you invested that £10,000 5 years ago. Like for like, these funds are almost identical, and if you are already investing in one, then it's certainly not worth considering investing in the other, unless there's a platform fee reason for doing so. If you're looking for less risk in investing in the S&P 500, then the Ishares CORE S&P 500 US dollar version of the ETF, with a ticker of CSPX, is an interesting one. It's traded in US dollars rather than sterling on the London Stock Exchange, and has a slightly lower annualised performance of 13.05%. However, the standard deviation volatility figures for this one is a much lower 12.06%, and that's a lot lower than even the more globally diverse funds that we've featured so far. And the Sharpe Ratio is impressively almost double at 0.78. I think that currency might be playing a part in this one, but that's for another video. For the final comparison in this video, I wanted to look at emerging markets, not included in global funds but as standalone ETFs. So let's firstly look at the Vanguard FTSE Emerging Markets UCITS ETF, with a ticker for the accumulation version of VFEG and distribution VFEM. The ongoing charge figure for this one is slightly higher at 0.22%. That's £22 per year for every £10,000 worth of the fund that you own. This is low, but not quite as low as those global developed market funds that we featured earlier on. And it's the OCFs with the emerging market funds that contributes to higher OCFs with those global funds where emerging markets are included, which is a bit of a nuisance, being that they only account for roughly 8% of the fund. So buying an emerging markets ETF separately and making it 8% of your portfolio might be a cheaper way of doing things. You can then also choose how much exposure you want. This ETF tracks the FTSE Emerging Index, which consists of mid and large sized companies from the likes of China, India and Taiwan. The technology sector is big in these funds as well and accounts for 20.39% of this one. The top 10 companies make up 24% of this fund, with Taiwan Semiconductor making an appearance again at number 1. The 3-year standard deviation figure for this one is a palatable 15.93%, but the Sharpe Ratio is a negative minus 0.22. As it's longer established, I'm needing to refer to the VFEM version of the fund for the 5-year annualised returns, which is 2.47%. So £10,000 invested 5 years ago into this fund with no further investment since would have returned you £11,297.53. And although there are lots of ETFs that track emerging markets, only Vanguard tracks the FTSE version, with the remainder tracking the MSCI Emerging Market Index. So turning to this index, I've chosen the HSBC MSCI Emerging Markets ETF with a ticker of HEMC. And although this is a new accumulation version ETF, I've turned to this one given its low OCF, the fact that it's sterling denominated and that it's traded on the London Stock Exchange. The distribution version with a ticker of HMEF is what we will rely on for some of the figures for comparisons as it's been going longer. The OCF for this ETF is 0.1%. That's a lot lower than a lot of emerging market funds out there. It tracks the MSCI Emerging Markets Index, which, similarly to the FTSE Emerging Markets Index, tracks large and mid-sized companies from the likes of China and India. But something to be aware of in this particular index is that South Korea is also included, whereas South Korea is a developed country for the purposes of the FTSE indices. The point I'm making here is that if you do invest in multiple ETFs across the FTSE and MSCI indices, there may be crossover and you may end up investing in South Korea twice. This could mean overexposure to a potential country, region and sector that might not be in line with market capitalisation, so it's just worth checking on this. This ETF again is diverse but has much less holdings than the FTSE version at 1,339. China, India and Taiwan account for 80% of the ETF. It was 72% in the FTSE version. This time 12% is also attributable to South Korea. The tech sector accounts for 24.57% of the fund, slightly larger, and the top 10 companies account for 26% of the fund, again with Taiwan Semiconductor being at the top. Using the HMEF version for risk, the 3-year standard deviation for this one is higher at 17.70%, and the 3-year Sharpe Ratio figure is more negative at 0.39. And the 5-year annualised return for this one is lower at 2.23%. Therefore, if you'd invested at £10,000 5 years ago with no further investments, you now have £11,165.85. This HSBC fund seems to have higher volatility and lower performance than the Vanguard fund, but with a significantly lower OCF. And just because it's performed worse in the past does not mean that it will continue to perform badly in the future. So this one for me is a difficult one to call. Overall, the figures for the emerging market funds that we've covered are not great when compared with those global funds that we featured earlier. I think a way to look at emerging markets is, will emerging markets become developed markets at some stage? And do I want skin in the game? There are obviously potential powerhouse countries within this fund, but with all the added macroeconomics, when will that potential be fulfilled? Ask yourself the question whether you want to exclude countries such as India and China, or at least have some exposure to emerging markets to enable you to cover all the bases for the future. So going back to the original question raised, I don't think that I favour Vanguard funds per se. It's just that I've had Vanguard funds in my portfolio since I started investing, so they often feature in the videos that I cover. My investment journey started with Vanguard, and I've just tried to remain consistent by investing in the same funds as I've gone forward. I accept that there are some similar and cheaper options out there, but when comparing apples with apples, the choices are more limited than would seem apparent. It's only when you start looking at ETFs that track different indices that the choices started opening up more. But even then, choices are more limited when you try to keep OCFs low and where you try to choose sterling denominated versions that are traded on the London Stock Exchange to keep those forex fees low. If I was starting over, I might put alternatives in my portfolio, but as things stand, and in the absence of seeing anything groundbreaking in the research I've done, I don't think there are significant differences between the funds I've compared to merit this. I hope that these comparisons and this video has been useful to you, and that it will be a useful research tool for you when deciding what provider to go with. These next videos look at some global funds and ETFs that have provided some of the best returns. Thanks for watching.